Happy Monday, Chris here with the Growth team. Really excited to get some information out to you as we are in unique times. Simply put, we have never been in an economic situation like this where we see the Fed decision on the funds rate continue with potential correction, further correction happening in the stock market. So where it boils down to, what I want to talk about first is you have short-term expectations and long-term expectations. And what that means to you as a potential purchaser of real estate or as a real estate agent advising in purchases is the short-term expectations affects contracts today. Because even if rates are eventually maybe going to get better with stock market correction, there could be volatility along the way, and you don't want to gamble with a monthly payment now that you've locked in a contract and are moving forward. But when it comes to the long-term expectations of rates, and we'll talk about both, that's where getting potential clients off the fence, considering lining things up to move forward on potential purchase, that's where those expectations can come in more into play. So here you have just the big picture and then the zoomed in if you have a contract. So essentially what we're seeing here, I'm popping two charts up here to my right, your left, here to show the mortgage bonds. The Fannie Mae mortgage 30-year fixed bond is on the top, and then the bottom here is then the Dow Jones. And what's really cool is you can see that the market has reacted exactly opposite of each other. So essentially you can see on that Monday that we saw a big boost for mortgage bonds, but that and then lost that ground. So that Japanese candle closing lower, but you can see it went really high, was basically inverse of the stock market. And then you can see how the stocks markets is you're very happy with the 401k improvement there and retirement outlook. The Dow Jones and other market indexes have improved, whereas likewise rates the bond has declined slightly. So where we get into then the short term, it is a volatile market and not a market to mess around. And so that's where we are locking clients actively, even though a further correction in the stock market may lead to lower rates. So right now with that volatility and bouncing up and down, we could see 30 days of rate worsening and then all of a sudden see a major correction, and so it's not something that you want to gamble with. But again, to speak more to that longer term perspective, there is still a lot of bearish sentiments in the stock market, and bearish sentiments and ideas that we are far due for a major stock market correction. That is going to help rates. And also with the Fed moving rates, I know we talked the funds rate, we've talked a lot and been nervous about the Fed moving rates this year and what that's going to do to rates. But right now what we're kind of seeing is almost a reversal trend, that once the Fed does change that, two things is we've already could have seen a lot of that correction and fear priced into the market. And just like we saw when QE3 backed off, rates got better. Even though people were so worried what was going to happen after the subsidy ceased, what we could see now is that once the Fed is predictable and moves rates, that could boost our markets. And along with that, that could help then that could help the stock market outlook as well. So those two things are now going to really weigh in on the long term for rates. And as we head into the fourth quarter, or finish out the third quarter this year and head into the fourth and even to 2016, we're pretty optimistic right now for rates. We are beating expectations and continue to do that as far as where rates are right now. But again, in that short-term picture, don't take it for granted and don't gamble with your clients' money. So this was a long one today, but some good information. Hopefully, always appreciate your feedback as we try and help make the best decisions and give talking points that we can all be on the same page with. All right, thanks guys. Go get them.